the mission doesn't also need to be grandiose. The mission can be, we're going to be the best hotel operator in the world. That has to come from a real place. But when it does, then everyone can be aligned around that. And there's a common North Star of what everyone is after. So it's up to the leader to define, this is who we are, this is who we're becoming. And again, I think where companies can kind of lose their way is they actually try to adopt a mission that's not core to who they are and what they're trying to do.
I thought a cool place to start would be to talk about how your military career has shaped your life and has impacted your business career. Because personally, my coach that I use was in the military, and the way that he thinks about things is very different from, I think, a lot of my peers think about things that weren't in the military. And I place people in the military on kind of this high pedestal. And I think other business leaders and CEOs do that too. So I kind of want to understand it better from your perspective and how it's shaped your life and career.
I'll start with a quick anecdote. One of my mentors and one of my first bosses was a West Point grad who had extensive experience in combat zones and led people in combat. And I was in his office. We were going through an Argus model that he was correcting me on. And then someone, really, it came into his office with, she was very frantic and said this was an emergency and listed off a number of reasons. It was a property management related issue and an office property. And he patiently listened, wrote down notes of, he got all the facts, and then she walked out. And then he calmly turned to me and said, that was not an emergency. And I think the context there is what I have always appreciated about men and women who serve is they have a good appreciation and a good context for what is important, what is an emergency, how to deal with stressful situations. And so for me, I'm so grateful for my military experience. One, I grew up, I have an amazing mom. We're very close. For the big part of my childhood, it was I lived in a single mother household, and she would be the first to say that I didn't have, let's call it a lot of structure. I kind of, and I was also a pretty rebellious child and classic, probably like many of your guests, ADD and then was rebellious in many ways. And by the way, I have a great relationship with my dad to this day, but a good portion of my life, it was my mom and my brother and I. And so I went to the Air Force Academy because thankfully for me, they let short but slow linebackers play at Air Force. Air Force, by the way, number 17th in the nation. I'm very proud of my team right now. But I got structure that I desperately needed when I went to the Air Force Academy. And I was driven by this motivation initially to play football. And then once I got there, after I went through basic training and went through the first year as a freshman, which is pretty difficult. It's not your average college experience, so to say. And grew a love and appreciation for the service. But really what I realized is structure is so foundational and key for my happiness, for my own personal flourishing. And I learned that in the military. I learned that, I need structure. Structure is actually, it's the classic Jocko phrase, but discipline is freedom. I recognize that discipline in my life actually created a lot of what I wanted to, who I wanted to be and how I wanted to serve others. And so for that, I'll always be grateful for the military. And then the last thing I'll say, and this is great as a leader in team building, and you try to create this in companies that you either start or are part of, but having a shared mission, having a shared purpose. It is it's magic for culture. It's magic for building unity and towards an objective and a mission. And so, what I loved about those that I worked with is we all had the same mission, we all had the same purpose, and very diverse group that I served with in different capacities. But there was a level of trust and that really made my military experience. People always come up and say thank you for your service, and I often want to try to explain, like, I loved serving. It was an absolute gift, and I feel really blessed that I got that opportunity. And I know many friends and have a few friends who gave their lives, and that's who I want to point to when people say thank you for your service, because there's a lot of folks who gave a lot more than I did. I felt like I was the recipient more than the giver.
What were the biggest things you noticed transitioning from military life to business life?
I'm passionate about this subject because servicemen and women have incredible experience sets. Oftentimes, those experience sets don't translate into a resume that a business leader can look at and say, okay, I know exactly how this person fits in. Which junior officers, a great transition for them is to go to business school, then go into the workforce. I would say, for me, the biggest challenge initially was that same level of passion and shared mission that you're looking for it coming out of the service, and not necessarily experiencing that. And so that was a challenge. Now, overcoming that by, as you mentioned, there are a lot of folks. I was fortunate that saw my military experience as a benefit, and from hiring around character and then passion. I was fortunate to work under folks who really trained me up, and even though I was a few years behind in learning, a lot of the X's and O's of real estate, were able to train me, but believed in kind of the intrinsic values that I had coming from the military.
How important is company mission? Because you talked about everyone's aligned around a common mission or goal in the military. But I know when I was starting my company, I didn't have a mission. I didn't have a vision. I was just like, I'm going to go out and do hotels. And you're kind of figuring it out as you go along. But you've seen a bunch of different companies. You've worked at many different places. How does mission work in the business world? And when is it correctly done? When is it not done? What have you seen?
Well, I mean, it has to come from an authentic place. It can't be made up. And I found that the mission doesn't also need to be grandiose. The mission can be, we're going to be the best hotel operator in the world, or we're going to be the best GP sponsor for Farmland. And that has to come from a real place. But when it does, then everyone can be aligned around that. And there's a common North Star of what everyone is after. So mission also is going to be there, whether you create it or not, or say it or not. It's just, is it a good mission or a bad mission? Every organization is going to be pointed in a direction. It's up to the leader to define, this is who we are, this is who we're becoming. And it makes a huge difference. It makes a huge difference when that mission is inspiring and is clear. And so, and again, I think where companies can kind of lose their way is they actually try to adopt a mission that's not core to who they are and what they're trying to do. And I think so the more simple, the more on target that it is with the circle of competence that you have and what you're focused on doing. And so again, one of the best missions could be that we're going to be the best hotel operator in the world, and that's a long-term mission, and everyone can get aligned around that. Everyone understands, that you're marching in that direction.
I want to move to real estate and why real estate was something you wanted to spend your time doing. And then maybe you can kind of narrate your story in real estate and why you decided to land in each place that you landed.
Yeah, thanks, Jake. The genesis for me, the Air Force was very kind to put me through grad school. I was in a grad school program while I was a second and first lieutenant at Los Angeles Air Force Base, and went to school in the evening for an executive program. And it was a business school. I was on the business side of the Air Force working I was a contracting officer working alongside Lockheed Martin on the Atlas V launch vehicle. So I always say I got used to being the dumbest guy in the room because I literally worked with rocket scientists, and I was not a rocket scientist. I was a business liaison for the Air Force, but they sent me to business school, and I loved business school. I loved classes on equities, loved classes on bonds, the language of business, learning accounting. The class that really stood out to me that I could understand more intuitively the first principles was a real estate finance class. And I could describe it like this. I mean, I could study and tell you all about different asset classes, but real estate, I just intuitively understood, okay, you can take a piece of land, you can take a property, you can increase value, you can increase rents, and all of it was more intuitive to me. And it was in that class that I realized, okay, like this is it. Like I want to get into real estate when I get out. And so when I got out of the Air Force, I went to work for a private REIT that was based out of Chicago, and they were doing big box industrial development in the Inland Empire, which, Paris and Moreno Valley, large, million square foot distribution buildings. And this was 06, 07, and learning, spending my 14 hours a day on Argus, but the underwriting with cap rates going down into perpetuity and rents going up into perpetuity, and that I was underwriting in a classically in a classic bubble. And so when the Great Recession hit, we had built a lot of building spec in the Inland Empire, and I had developed a mentorship relationship with the CEO, and our shop in Los Angeles shrank from 50 people to 3. And I begged and pleaded, said, I'll sweep floors. I'll do really whatever it takes if you keep me on. And I think because I was cheap, and he probably felt sorry for me, he moved me to what he called an asset manager role, but it's essentially a leasing role to lease up these vacant assets in the Inland Empire, with a nice way of saying, okay, Trevor will eventually die on the vine. And so by no skill, I'd say a lot of hard work, but there's an expression I love, that luck is when preparedness meets opportunity. I was prepared to work hard. I learned a lot in that process. I learned that I love the transaction side of the business and love the deal making side of the business. I had spent a few years learning about real estate as an asset class and underwriting real estate. And that particular submarket, that particular asset class just turned around quicker than anyone thought. And we were able to stabilize those assets. I got credit for something I shouldn't have got credit for, but I learned a lot. And, going back to your question around transferring from the military, for me, that was a key moment because it accelerated my learning. And I was 5 years behind my peer set coming out of the military. And I was able to catch up pretty quickly because of what was a really stressful and a really hard time. And so out of that, I was recruited by a West Point guy to come join Parkway Properties, which is a publicly traded REIT, office REIT. At that time, based out of Jackson, Mississippi. They're now based out of Orlando, and had the opportunity to come join as a managing director of that REIT, learn office asset class, and really we were trying to do two things: lease a 12-building suburban office portfolio, which I loved and came naturally to me, both leasing and the relationship and negotiation with brokers. And then we were growing a third-party management business. The company had always held on to third-party contracts after it had sold assets and had not intentionally grown that part of the business. So we grew that business and then was recruited by CBRE to come join as their managing director over the office tenant rep group in Houston. So the genesis really came from the class and when I was still in the Air Force, and then just had the opportunity to be part of different asset classes, different opportunities as they came up. Really have loved each asset class along the way and the nuances of each of them.
Is there anything about a particular asset class that you saw that you were glad you weren't running the show or particularly heavily invested in that you're going to tend to shy away from? Or maybe it's a location or some sort of metric or attribute that you saw during the GFC that you're like, yeah, I'm going to stick far away from that one forever.
No, I didn't get a bad taste in my mouth or have any particular issue with the asset class. I think each asset class you can make the same mistakes, and I think in development you can obviously be in the wrong part of the cycle, I think what I've always learned from that experience for me was a measure of conservatism in my underwriting that I have to this day. I always have that in my mind of, a more aggressive underwriting in that era has put enough scars in for me that I'm probably a little too conservative in my underwriting. And it's probably one of the reasons why I've ended up loving Farmland so much, which we can get into. But no, I think, didn't have a particular bad taste in my mouth from any asset class. I think that it was more just a measure of conservatism and underwriting and maybe more of a proclivity towards safer assets is what came out of that.
What were the top 3 things you learned being a younger person, new in real estate during the GFC?
I'd say the first is be cognizant of cycles and which part of the cycle that you might be in. And I was a younger person, so more following orders and diligently underwriting what I was being told to underwrite. But I think what I've learned since then is be really cognizant of the moment of cycle, and it's impossible to know the exact, but you can generally know which part of the cycle you're in, and I think you should your underwriting should reflect that, and so that would be the top. I mean, the classic one is not to be over leveraged, and I think be very careful with leverage, and again. With our farmland assets, we never have more than 50% leverage. Sometimes we have less. And so I think for holding assets for the longer term, you want to be very cautious of being over levered, and obviously that was the primary issue in the Great Recession. Yeah, I think that the third just being that, like I mentioned before, there's always opportunity in adversity, and while that was a very traumatic event for many people, it was also the start of a new cycle where folks who were prepared and firms that were prepared for uh, backing up the truck and buying assets, or and that did really well. So that there's a lot of opportunity coming out of adversity, and being prepared for that, to being prepared to take advantage of adversity when it comes.
Did those three principles change at all, or did you add a new one to the list, having gone through COVID and now entering a interest rate rise cycle?
They're still true, and not being over levered is I think particularly true in a interest rate environment that I think is probably here to stay, and is the new normal. And yeah, those principles I think only got more true coming out of the pandemic, and then into this environment that we're in now with a new norm for interest rates.
Do you think it's possible to create real generational wealth without significant amounts of leverage, or let's just say leverage above 60%? Because leverage kills everyone. That's what it always is. It's leverage. So can you create this wealth without putting on a good amount of leverage?
It all depends on time. And if you want generational wealth quicker, I think you're going to need to use leverage, and you're going to need to be in the right part of the cycle when you're using that leverage. And many people have done that. Many people will continue to do that. I think for me, I think about generational wealth, truly generational, multi-decades, 40, 50, 60 years. And if you can compound 11, 12% annually for 40, 50 years in long-term assets, then you can build generational wealth. You're not going to get rich quick. You're not going to see that next year, or you're not going to 10x your wealth in a short period of time. But I think I've always been a fan of Warren Buffett and Munger, and I subscribe to that philosophy of the compound interest equation. One of the most important factors of that equation is time.
So in today's environment where everyone is looking to get rich quick and everyone is trying to optimize whatever business they're in, but you mostly see it in real estate to maximize time, what have you learned being in the business now for 15 plus years?
Well, I mean, it leads to why we've gotten focused on a farmland strategy. But one of the principles that we've arrived at is we want to be in generational assets where risk is decreased, volatility is decreased, and you can still realize good returns. Get low double-digit returns over the long term, and do create wealth. It's just over a longer period of time in an asset that has principles that you like from a macro perspective, and we can get into that. But I think where we've arrived is to play more of a long-term game, to preserve and grow capital, as opposed to try to double our money in a year, or even in 3 or 4 years, but see a 3x multiple over 10 years. And that's why we're excited about Farmland.
Let's talk about it. So a couple of years ago, there was a lot of talk about all these mega wealthy people owning farmland, owning ranch land. And it reminds me of like maybe 18 months ago when you heard Jeff Bezos and Elon Musk saying they were selling stock. So it's almost like these people were getting into farmland, they were selling stock. Is this the new frontier? How did you end up investing in farmland, which I thought was mostly owned by big farming companies or farmers? How did that path happen?
I love that anecdote or the analogy of the billionaires that have the future is the future is here, just not evenly distributed. And I think it's good to see what billionaires are doing and ask why they are. So yeah, how we got into farmland, coming out of the pandemic, I'd say early April, May, our firm was concerned about inflation, and I think most people are concerned about inflation. Saw uh, the printing of money and this vast increase in government spending, and didn't take a rocket scientist to see that inflation was going to come down the pike. I think that the other thing that we were concerned with was the where asset prices were in other asset classes. We traditionally had invested in office assets and retail, and even the public equity market. After things had rebounded quite significantly in late 2020. Prices were still really high in multiple asset classes. And we weren't thinking that we weren't being doomsday in what we thought was going to come, but we just thought a correction was going to come in many of these different assets that were overpriced. And so we were looking for a non-correlated asset that was an inflation hedge. And when you put those two together, that's it. It's not long before you find farmland. Farmland has historically been an inflation hedge for pretty obvious reasons because of the product that it produces is directly tied to CPI, food, fuel, and fiber. And then in a very interesting way, in a way that we didn't fully know and understand, farmland had historically been negatively correlated to public equities and not correlated at all to other real estate asset classes. And we started to really ask why. And that was a multi-month, almost a year process to really try to get smart on the subject. And what I'd still say is we're not experts by any means or have learned everything we want to learn about the asset class. We still love to ask dumb questions from the smartest people in the space. But what we found out was a few things. One, farmland as an asset is in the United States is $3.4 trillion. So it's every bit as big as the multifamily market or the office market. And yet it had really low representation of institutional capital. I mean, the private equity into the space was about 35 billion at the time, which was, so less than about 1% of the entire asset class was private equity. We had seen the headlines that you reference of billionaires buying farmland, and that's another, percentage of that ownership. But primarily, to your point, farmland's owned by generational farmers, and without a lot of private equity or institutional capital in the space. So that was interesting to us. We liked that probably we're early into an asset class that was going to see more institutional capital. The other thing that we liked, and the primary reason why farmland doesn't correlate with other asset classes, were just the macro supply and demand fundamentals. You have a growing population, global population, and a growing global middle class. And so the demand for food, fuel, and fiber is only going to increase. And I think that's pretty clear and obvious to anyone who sees those global trends. The other interesting part of the asset class, unique to other real estate asset classes, is the supply of farmland is actually decreasing at a pretty significant clip. So the farmland the size of the state of Wisconsin has been taken off of the market because of new development, primarily, and water issues in some states. So you have a supply of farmland that's actually decreasing while the demand is growing. And so we felt pretty good about the macro factors, and then the lack of institutional competition in the space to be early. And so we got really interested when you combine that with the asset itself being an inflation hedge, and with some good historical return numbers, low double digit returns, and decided that this was an asset class we really wanted to focus on.
So how do you go about transitioning from an office and retail shop, private equity business, to a farmland investing business?
Well, and I should back up and say that Macfarlan Capital Partners is a 40-year history of being a GP sponsor, and historically doing individually capitalized deals. Great track record of success. We're based in Dallas and have a group of investors who are family offices and high net worth individuals. And the firm has done a great job of creating great performance in each of these investments over time, and built up a lot of trust and a great brand. And part of the principle or theme of the firm has always been thematic investment. So I think our mutual friend, Chris, can easily tell me all the reasons why being a thematic investor has some disadvantages, and it does. No question about it. Harder to scale. You can't be focused. To the mission comment, you can't be necessarily the best in the world, but there's some advantages to being a thematic investor. And primarily, it's around finding the right opportunities in the right cycle for the asset that you want to invest in. And so the firm has had a track record of success of pivoting to asset classes that were right for the season, right for the moment, and really focusing on those assets in that given time. So that concept wasn't necessarily new in late 2020 when we pivoted to farmland, but farmland is a leap from what you call traditional commercial real estate, while having a lot of characteristics that are similar. So the process for us was, one, getting convicted ourselves that this was the right time to put a significant amount of our focus into the asset class, to understand the asset class generally and to understand how we would enter it specifically. Once we got convicted around that, then it was a matter of communicating to our investors why, in late 2020, we had lost conviction in investing in suburban value add office, and why we had gained conviction of investing in farmland. And so, to the credit of our founder, Dean Macfarlan, my partner, Mac Macfarlan, and our team, we were able to communicate this to our investors, and a good percentage of investors who had never invested in farmland before all of a sudden got really interested in the asset class for the same reasons that we did, and came along with us into investing in farmland. And our first investment was in 2021.
I'd love for you to talk about the advantage that a 40-year real estate GP has when they're going to start another real estate vertical. I think there's a ton of value in specialization, but real estate people probably like to overcomplicate what real estate is. And a lot of real estate is very much the same, whether it's multifamily, office, retail, it's the same core principles. But how easy was it for you to spool up a new asset class because you had this 40-year infrastructure already in place? Or how difficult was it? I mean, maybe it was hard.
The 40-year history was immensely helpful because of a track record of trust and performance. And I think I've heard you say this before on your podcast, and anyone who's in the real estate industry and in our position as GPs know this to be a fact, that at the end of the day, our greatest asset, and really our primary asset, is our reputation. And so we have to be above reproach and deliver for LPs and deliver for all of our stakeholders, because that's, at the end of the day, all we have. And so the benefit we had was a great track record and trust with a group of LPs who we'd been with for multi-decades. And not every investment that they've invested with was, a complete grand slam. But the way that the firm handled the investments that were challenging and then the investments that were a success, it helped us in so many ways to be able to make the pivot. Really, so the only equity that we had to make the pivot was that trust. So that it was extremely helpful. And I think that, going back to the history being one of thematic investment, it wasn't a complete surprise for the investor base to see that there was a pivot into a new asset class, because had been the history, to find the opportunistic times to invest into a new real estate class when we had lost conviction about a strategy that we had before. Yeah, what made it a challenge and why it took us 18 months until we did our first farmland deal is we had to find how we were going to enter the market in a way that we had conviction that we've created some advantage for our investors, and that it was a deal structure that we felt really confident about. And so we didn't rush into that. It took a long period of diligence for us, and in discovering what was the right way to enter the space. But once we had determined that, then our investors were at that point excited about entering the asset class with us.
I want to go with that a little bit, because when you're new and you're starting your new real estate company, you have the benefit of not knowing what you don't know. But when you are experienced and you have a 40-year reputation, you know what you don't know. So how did you overcome the objections internally with yourself to go out and avoid thinking at every turn you were the dumb money coming in? Like, if we're getting this deal, if we have the opportunity to buy this piece of farmland, what other smart people passed on this one? How did you overcome those objections, like internally and from your investors who might also be concerned about the same thing?
I love this question, Jake. And it goes back to, in addition to companies having a mission being extremely important, companies having principles by which they make decisions is also incredibly important. So I mentioned a principle of thematic investment. That principle is rooted in, we're going to find the right opportunities and not be stuck in a mindset that doesn't create the best opportunities for our investors. A second principle for us that is extremely important is we have never been fully integrated in any of the investments that we've invested in any asset classes. So, and you know this better than anyone, of finding the best in class operator, and how important that is to your business. It's particularly important in farmland. And so the principle that we that guided us to find the right investment was starting first with the operator. And so in farmland, that's finding best in class farmers. So we really dug into the landscape. And so going back to farmland being $3.4 trillion asset class, very little institutional capital in the space. The other dynamic that's happening that we discovered was happening in farmland is similar to the small to medium sized business environment, the silver tsunami. And there's a silver tsunami in farmland. It's just that the average age of farmers are 60 to 65. In that 98% owned by generational farmers, there's a huge percentage of that farmland where the next generation either doesn't have the skill or the will to farm. And so a majority of transactions are occurring because of that dynamic. And a lot of times it was more, farmers who are successful who are buying those parts, those land from the farmers who didn't have the next gen to farm. So we were looking for already successful farmers who had built up scale because of that dynamic. And so some of the things that we were looking for was farmers who were farming at scale, who had already started to aggregate a larger portfolio of farmland assets that, which you can check this, that have been historically outperforming the county averages in yields in the crops that they've been farming using technology and systems and team structure that really created better yields in farmland. And then, frankly, that were entrepreneurial and wanted to grow and wanting to go to that type of operator with more of a private equity growth strategy that we could help fuel their growth if they would in turn help us source, identify deals that they felt were rightly priced, that they really wanted to own longer term, and that we could create a unique deal structure that was mutually beneficial for the farmer and for our investors. And I can get more into that, but the simple principle is we would not enter the space unless we could identify who those best in class operators were and really create a mutually beneficial partnership with them.
So is what you're finding in investing in farmland, is it more important to find the good operator who maybe can identify the land and farm the land versus finding a good piece of farmland that's really nutrient dense and well located and then finding the operator after? Which one is it?
Well, we think both, and we think the way to get to both is start with the operator. And so, because the operator in a particular region, if they're truly best in class, and you can create a mutually beneficial deal structure with them and help fuel their growth, they're going to help identify the best, both best priced and then along with that, the right farms to buy, whether that is things that have been overlooked, the soil quality itself, the things that they know that only they can know. So you can see just how important the operator relationship is to us in our strategy. And we, in order to meet operators, you have to look at farms. And we in that period, the 18-month period, underwrote more than a dozen farms. But what we were doing was underwriting farming operators. And we were looking for that initial partnership that we could start with. And we found that in an operator in Northeast Montana, a young man who has a young family, started with 600 acres that he leased. And when we first met him, he was up to about 50,000 acres of farmland that he either owned or leased. He was outperforming county averages. And what he wanted was capital to grow. He had farms that he wanted to purchase or farms that he really wanted to operate. And he was looking in Montana, South Dakota. And we were able to, one, develop trust with him over a period of time, and help solve the need for him that we could provide capital to help him expand his operation. And in turn, he could be an excellent operator for us. And we could create deal structures that were beneficial to him and to our investors.
So how are you structuring these deals? Is the farmer or the operator leasing the land from you and he's basically at risk for whatever happens, if he has a great year, if he has a bad year? Or are you, in a sense, partnering with him in the business and kind of maybe paying him a fee, but then sharing in the upside of the fruits of your bounty?
Yeah. Well, let me take a step back and just, I think our audience, your audience is primarily real estate investors, real estate operators, owners. So it's very similar to other real estate asset classes in that the two ways that a farmland asset is going to make money is through whatever annual yield or income the asset can create, and then the appreciation of the underlying asset. And those are your two ways that the investment makes money. Farmland has traditionally much lower cap rates than most real estate asset classes. And it varies just like other real estate asset classes by region and by the there's a class A, and it's not called class A, class B, class C, but farmland has its own range of cap rates that you can buy into. And then the traditional farmland structure is either a lease that it's interesting in farmland, the lease gets paid upfront in March. It's a one-time payment, or farmland has crop share, where essentially you are participating in a percentage of the revenue, and you're participating in essentially the upside or the downside. I'll give you a anecdote or a case study of kind of, I keep on saying mutually beneficial agreement, and need to maybe provide an example to provide more context or color around what exactly we do. Our farming partner, for instance, a deal that we're taking to market here soon. He identified a farm that he thinks is he calls it a steal. We don't use that terminology. We think it's well priced based on the surrounding comps in the area. The per acre price is below the comp. Our farmer thinks it's a steal because he sees that the current farm has only been farmed on an annual lease and hasn't been farmed for the long term with the right crop rotation to really create the yield that he thinks that farm can generate. So he thinks it's well priced. He also wants to own his farmland generationally for his family. He wants to grow his operation, but then he has young kids. Ideally, in a perfect world, he'd love to own a majority of the farms he's currently leasing. So knowing what's important to him, and then we went out to the farm where he was in South Dakota, and I spent the first day with him on the tractor and just talking about his operation. And you can see really quickly why he has been excellent, because we're talking, he's telling me all about his story and how he and his wife got married. And then he stops me, and on his John Deere tractor, there's it looks like a F-15 cockpit. He sees one of his operators, one of his team on a different farm, miss a spot that's like 10 feet wide. He calls him up, says, "Hey, you missed a spot. You need to go pick that up." And I had already known this about our operating partner, but he's OCD, and I'm like, "Oh, I get why you've been so successful. You deeply care that every little thing is done with excellence." So we spent the first day with him on the farm. That was great. The second day on the farm, we go out and we're literally sitting on his tractor, and I pull out my laptop and I pull up our financial model, and I say, "Hey, in order to buy this farm, we're in a completely different interest rate environment. The risk-free rate is, I think I showed him the 1-year treasury bill, and it was like 5.3%. It's like, this is what our investors can make without lifting a finger. And they do not need to invest in farmland unless they have a compelling reason why they are going to get a better investment than what this is." And he's super smart, got it right away. And in our model, we said, okay, if we buy this farm and we have this amount of debt, we need to back into a cash yield that has a premium to this risk-free rate. And then the appreciation of the land is all upside to our investors. And now we have a compelling investment for our investors, that we have a premium to what the risk-free rate is, and then we have appreciation of the asset. And, we're just describing to him, like, our investors, they don't need this huge IRR, but they need an IRR that is safe, that they can feel really good about, and they're going to, put a portion of their allocation in the farmland. They feel good about this allocation. And we know that you want to buy this farm eventually and that you see a lot of value in the farm. So we can give you a purchase option in year 5 and then in year 10 that can back into our IRR with the appreciation. You feel good about it because of the value. And then you're able to pay this above market lease rate that gets us to the 8% average cash yield over the lifetime of the lease, which in farmland, to get that type of yield is rare. Farmland, again, traditionally has much lower cap rates. But he was able to do that because we were able to solve his need of providing capital. He can now farm this for the long term. He has this purchase option. Our investors, feel great about it because it's a unique yield in a safe asset like farmland that then has upside appreciation. And it's truly a win-win. And that's the type of structure we want to repeat. And our objective is that as many options that our operators execute, that's the better. That's our flywheel. We're solving a huge need for them. Our investors are happy. The options that don't get executed, then we want to build a portfolio of farmland and have a larger portfolio that an institutional investor would eventually be interested in purchasing. Because the issue with farmland is that there aren't a lot of large farms to invest in, and there's not a lot of aggregated portfolios for institutional capital to buy. But institutional capital wants to enter the space. They like the non-correlated asset. They like its low volatility. They like the return profile. It's just been a difficult asset to enter into. So we want to aggregate a larger portfolio that eventually we could provide as an investment to institutional investors.
In a specific deal, what would need to happen for you to want to enter into a crop share model as opposed to a lease model?
It's a great question. What you're essentially doing there is it's a risk return profile, and we'd have to feel really good about underwriting the downside scenario of both commodity price risk and then historical yields. And there is an interesting element to farmland investment that's worth noting, which is federal crop insurance, which will subsidize. It's subsidized insurance that covers a loss in a down year for a harvest, and that's unique. And that's in farmland. And the purpose of that legislation is to ensure that our U.S. food supply continues to be robust and that farmers are incentivized to farm no matter what. And so it's great from an investment standpoint because it does protect your downside. But we'd have to really understand what the insurance rate is, what the insurance payout is in a down year, and understand really deeply what the risk is on the downside, and then get really comfortable on what the upside could be, so that our very conservative underwriting of a more of a volatile yield, not a straight lease yield, we feel really confident about. And in a crop share agreement, your yields are going to be higher if you're making the investment. You're believing that yields are going to be higher over the average of the 10-year versus the lease. You're just accepting more risk of the volatility of the annual cash flows.
What surprised you most about underwriting your first couple of farmland deals and diligencing them?
Yeah, I mean, this wasn't a surprise, but there's not as much information in farmland as other asset classes. So you really have to go and get that again, for us, that's why our operating partner and alignment with the operating partner is so key, is that we never wanted to be solely beholden to our operating partner for all of our underwriting. We do all of our underwriting in addition to what our operator is telling us, but for the operator to validate our assumptions around soil crop quality, around projections of yield, around the value of the land. There are very few comps on the market, and you can get them. And finding great intermediaries who are the power law brokers in any given region. Yes, we have relationships with them, and we're getting information from them. But then there's a lot of off-market information, comp data that our operator can help us get, and other relationships. And so it's important when you're at our scale, which is we're small, to focus on a region and really dive into relationships in that region. None of that was a surprise, and I think we're big fans of. There's a VC-backed group called Acre Trader, and they've started what essentially is the co-star of Farmland called acres.co. I think it's acres.com now. And they're doing a great job of starting to aggregate data and make it more streamlined. It's still a long ways away, and they'll always still be the co-star quality to something like acres.com. But there's more information coming in this space as it becomes, as more institutional investment enters it. But you really need to have boots on the ground, and you really need to dive in and validate each of the data sets that you're getting from that boots on the ground.
What does value add look like in farmland? In traditional real estate, multifamily, it's easy, redo the kitchens and bathrooms, and boom, you've created value and appreciation. What does that look like on the farming side of the world?
Yeah, I mean, I love the question. So we're in row crops, dryland row crops in Montana and South Dakota. There's a category of farmland investment that's permanent crops, where it's essentially any of the produce that you grow on trees, almonds, pistachios, fruit. And so by nature, if you're doing a permanent crop farmland and you are growing and you're growing these trees, which are depreciating assets, then you're creating value. And so if you're creating a permanent crop farm, that in its essence is value creating. And we have invested in vineyards, and so that's an obvious way to create value. I would say what we're doing in Montana and South Dakota is more around being very proactive about finding additional income sources, whether that be hospitality or hunting, which is really big in that region. And we love leaning in, facilitating those. There's a lot of government money that's geared towards solar and wind, and those are our opportunities that can generate income. And if you do that in the right way, there's some opportunity there. Cattle is another opportunity. There's for the when you're buying, for us, we're buying thousands of acres at a time. There's some really exciting opportunities to create income on the asset in a way that doesn't diminish the core income producing crops that you're looking to harvest. And so that's how we try to intentionally create value. It's never part of our underwriting. We always look at any of that additional income as upside for our investors, but we are very proactive in looking for those opportunities.
What about like tractors and the equipment? Is that owned by you as the farmland owner, or does that fall under the operator's P&L and he brings all the equipment and there's not a lot that you have to worry about there?
It's the latter. It falls under the opco, which is the farmer. And the farmer, again, what you're looking for, what we've been looking for in our farming partner with these farmers who are operating at scale is they have either owned or leased equipment that's best in class, and they have a team in place who's operating this equipment. And so that is part of the farmer's P&L. And really, what we look for is a farmer who has a great fleet and is past that stage of startup where they have the equipment in place and the team in place to grow. And so and that's not easy for farmers to get to. But there are a number of them who've hit that point and threshold, and now they're looking to expand and grow the amount of acres that they're farming.
So I know this is a new venture, 2021, but I'm sure you've had a deal go wrong that you either closed on or you didn't close on. Where have you seen things go wrong in your acquisition process?
Yeah, I think where it really boils down to is in due diligence, and really, it, we've really migrated, especially in this interest rate environment that we're in, towards the lease structure that really takes this kind of commodity price and yield price risk out of the deal. Um, and the only way you can create yield that I think is attractive to investors in the lease model is to create some kind of unique structure like we have, like I mentioned, where you're able to create a purchase option for the farmer who wants to grow and wants to own it. Where we've seen deals fall out is frankly when we have more of the crop share arrangement or an operating agreement model where we're participating in commodity price risk and yield risk, and we didn't get comfortable with the underwriting of what those yields would be, and we've entered kind of a double whammy of high interest rates and commodity prices have gone way down. Every commodity is different, but there's been a huge drop in prices for the crops that are primarily farmed in Montana and South Dakota, wheat and wheat primarily, soy. And so when commodity price, it's hard for us to see where commodity price is going if we don't see kind of light at the end of the tunnel. And then, we don't get comfortable with where historic yields have been. Once we kind of get into a deal, then that's where we've seen deals fall out, or we just weren't able to get comfortable with moving forward.
Are you capitalizing these investments deal by deal or as a fund with multiple farms in one investment vehicle?
We're doing it deal by deal. And I think we've always entertained a fund structure, but what we like about deal by deal, especially as we are in the early stages of this investment for us, is we will only invest in a farmland deal that we feel really convicted about. We're not have any undue pressure to get capital out. And it goes again with kind of our thematic investment principle. There'd be a lot of advantages to having captured capital, and we haven't completely ruled it out. I think especially as we start to get more of the flywheel spinning and we have a lot more deals under our belt. But for now, each of the farmlands are individually capitalized. A lot of the same LPs are in each deal, but they are deal by deal.
I want to transition and talk a little bit about the company, Macfarlan. You mentioned father and son. This has been going on for 40 years with a great track record. I've seen father-son businesses that either go really well or they go poorly, and maybe they lack kind of a succession plan or future beyond the founder. What's your experience been like in your company?
So, funny story about this, Jake, is my wife and I, right when we were thinking about joining Macfarlan, we started watching the show Succession, the HBO show, and what was funny is we were just starting to talk about actually joining as a partner with Dean and Mac, and I turned to my wife and said, the reason why this show is so good is that this family is an absolute train wreck, and that's what makes it so entertaining. And my observation of the Macfarlans is that they're the exact opposite. And not that there's not conflict, that they just handle it with a lot of health and they have an expression called "clear the air," where they address any issue that is underneath the surface. They have this wonderful habit of saying, "Hey, we need to clear the air on this. That like we're not like I don't like how this is going." And the reason why I had context to know this even before I joined is, Dean Macfarlan had been a mentor of mine for 10 years in Dallas real estate. He's very well known, and he was gracious to be a mentor for 10 years. I had started a company that he was the lead investor in, and not only was he a lead investor, he was the investor that would call every now and then just to check in. We had monthly meetings that I'd meet to present how things were going in the company. But after every business case study update of where we were, he'd always ask how I was doing as a leader, how I was doing as a husband, how I was doing as a father. I had, in the same time frame, struck up a friendship with Macfarlan and just saw that the apple had not fallen far from the tree of just character and competence. And so when they had asked, and this was coming out of what was really a healthy transition where Dean had stepped into a senior advisor role, Mac had stepped into the senior manager role. They were looking for a partner to come in with Mac. And when they had reached out to see if I was interested, I did not have to underwrite character. I mean, I knew I had seen it so many times in spades. So I feel really grateful for that. I've asked Mac and Dean what has made their transition so successful. And I think what they would go back to, and I've heard them both say this, is they never lost sight of the most important thing, which was their love for each other. And that allowed them, they are very open that it's not like they did not have conflict or didn't have to work out disagreements in how that transition would come about. But there was a mutual honoring and love for each other that led to what as far as I can see in my relationships with, and I've had a few different friends who haven't had such a great experience with this. It led to one of the better transitions that I've seen.
Do you think that's because they both were in alignment on the end state, like where they wanted to end up? They just maybe didn't know exactly how it was going to get there, but they were agreeing how it was all going to end?
They agree that they both wanted what was best for the other. They also agreed that they didn't know or weren't, they didn't know how to get there. They were clear at the beginning that that there might be a disagreement of how they get there, but they were okay with that because they both wanted what was best for each other, and they did want the ultimate end goal. So I think they were clear on both the end goal and that they may not be completely aligned on how to get there, but they would work towards that in order to get there. Which I love thinking about that of, if you or I are in that blessed position to have a son who would want to continue on the business, it's a great lesson of just, wanting what's best for our children. Also being clear that we may not have the same agreement about how to get there, and that's okay. Like it's okay but we want to know where we're going. We agree on that, and then we're going to work together on really what's best, because I think that's how you get to the best answers to begin with. And in that scenario, probably both of them weren't right at the beginning about what the path should be, and they ended up finding the best solution as they worked together to find what the right path was.
What have you learned about reputation from Dean Macfarlan in the community as a person, as a business leader that you want to take with you in your career?
I just recently started to become more engaged on social media, and I still endeavor to do more so. But one of the best responses, and I'd love to include it in the show notes or just send it along, is Dean gave his top 10 life lessons to really kind of a small group of people. And with this permission, I shared it on X, and it got a great response. And it's really the embodiment of who he is. And I have it up on my wall now. But like the number one on the list is it's not about me. And for a guy who is as successful and has done really so much in the Texas real estate community, what he is just true down to his core is that he exists to serve others, and that's not BS. I mean, he exists to serve others, and that comes out in so many ways. And so what I would want to be known for, and you have to earn this over time, it's definitely compound interest and long obedience in the same direction. And, it could be taken away like that if you, don't have the right character in different moments, but that, to have a reputation that you exist to serve others and that be validated by 40 years, I think that's the gold standard.
Talk to me a little bit about, I don't know if it's like an abundance mindset or being open, but we actually just negotiated a deal with someone from Dallas, and he called me last night and was like, I had this idea of you, but when I was actually negotiating the deal with you, it was the reality of what I perceived. And that was that you're going to get to a rational decision pretty quickly, and we're not really going to go back and forth. I'm going to kind of tell you what I need. You're going to tell me what your needs are. And we kind of got there. And that was what he articulated in a way better way than I just did. But I've encountered a lot of people that the negotiation is exhausting and is a lot bigger than it needs to be. And I don't know if it's like Texas people or what, but I found Texas people are just like good to deal with, and they're not worried about like killing someone else to make themselves grow taller. I mean, I guess maybe in the oil days, like some of that happened, but maybe not. But like, I'm curious to get your take on that as someone in that environment. And it may be a fantasy I have, like these old Texas real estate guys wearing cowboy hats, but that's my view.
Oh man. Well, one, as a Texan, I'm glowing right now. I'd love that you'd associate that with Texas, and I hope it's true. Obviously, it's a principle that applies no matter where you live. And I would just say a few things. I have a mentor who is a Texan. His name is Terry Looper. He built a multi-billion-dollar oil business in Houston, and but he's one of the best listeners in the world. And I asked him about this, and he gave me an insight to this, is that, the key to any great relationship, and the key to great marriage, great mentorship relationship, and really to create a great deal is truly listening to the other person. And he calls it listening out. And if you have a zero sum mindset, and it's, I'm going to get mine, you're going to get yours, you're not really listening to what the other person really wants. And having that abundance mentality, one, you got to inherently believe that's true. But once you get there, then what you're really listening for in listening out to someone is how you can give them what they want. And by giving them what they want, you're able to create a win-win. And I would say, yeah, I agree with you. And I bet this is what this gentleman was saying about you, is that I only want to do deals with those who know that you can truly create win-win situations. You can really create what the other person wants and what you want if you do a good job of listening out. If you're not able to create that, maybe it's not worth doing the deal. And so that's what's great about, in my opinion, capitalism. That's what's great about free market system, is you can create situations that actually create more abundance with the right partnership and really searching to find how you can create the win-win. I think over time, those are the kind of use the Naval Ravikant quote. Those are the kind of the long-term people that you do long-term games with. I think that anyone can, be sharp-elbowed and really be zero sum and maybe do a good deal or two, but they won't be around, in the decades to come. And so I'm glad that you see it as a Texas quality. I hope that continues to be the case with so many people moving to Texas. But it's obviously a general principle that applies to really, I'd say any long-term person you want to do a long-term game with.
I think where a lot of people make a mistake, there's this great negotiating book called Never Split the Difference by Chris Voss. And I actually didn't fully appreciate, I think, until now what it means. But when you talk about a win-win, that means you're getting something great, I'm getting something great. Oftentimes, I think if you're not listening in a negotiation, you're only focusing on one win for one person, and then maybe how do you split that in half? As opposed to what you're articulating now is give them 100% of that win, but figure out what a win would look like for you, and then try and get 100% of whatever that is for you, which is not splitting up what theirs might have been.
Amen. Yeah. And a lot of times we don't listen well enough to actually realize that what they want is different than what you may have thought. I mean, to really listen out and understand what someone really wants, I think that's a lost art, or very few people do that. But using the example of our farmer, we spent months listening out from him. Hey, you want to own this generationally? Tell me more about that. Oh yeah, like it'd be a dream if my son, is farming this one day. But what I want more than anything is just this land for my family, for my grandkids. Okay. Well, if you didn't hear that, then that's a problem. You need to really listen, understand, like, this is really important to him. The other thing important to him, he wants to grow his operation. Okay. He wants to grow his operation. Okay. And then in turn, by respecting that, we're able to share with him, like, okay, here's what's important to us. Investors in this environment, they need a yield that's greater than the risk-free rate. And they don't need, an IRR that's 30%, but they need it mid-teen, and then what was great is we literally created a win-win by giving him what he wanted and what we wanted. And it was a true win-win. And so those exist all over the place, but you have to have relationship, trust, and you have to listen out in order to create them.
I want to kind of end on mentors, because as the conversation's gone on, it seems like mentors have been very impactful to your life. And we've also talked about being intentioned in what you do. So how do you interact with your mentor where it's a true mentor-mentee relationship, as opposed to a mentor that you're the only one that thinks he's the mentor, but the actual mentor doesn't really think he's mentoring you, which happens to a lot of people. So how do you interact, I'm curious to know, with your mentors in a purposeful way?
Yeah. Well, I love this question. And the most valuable commodity that any of us have is time. And so starting from that reality and that principle, to honor any relationship, you need to honor time. And so with mentors, and I always maybe intuitively have done this, but now I share with any younger person coming out of college seeking a mentorship relationship. You need to, one, honor the time. So how do you honor someone's time? Before any meeting with a mentor that you truly want to learn from, be prepared. Know exactly what you want to ask. Have defined questions. Questions unlock so much. If you can ask the right questions, you can get the right answers. And so spending time to think about, okay, what is it that I'm struggling with? What do I need to learn from this person? This person has unique experience here. What question do I want to ask? So intentionality on the front end with questions. And then what is often lacked too is in the follow up, because if you want to honor a mentor's time, then you follow up and say, here is what we talked about. And then here is what I'm doing in my life because of what you told me. And I'm amazed at how rare that is, and how the most important people in my life who have the least amount of bandwidth find that to be so rare that people do that, to follow up and say, hey, we talked about this, this, and this. Because of this, I'm now doing this with my wife. My wife and I are having a weekly meeting, a weekly touch-in point. I'm now doing this with my son. I made this change in my business. And you show the mentor exactly the action you took because of the wisdom that they gave you. I tell, folks that, younger folks that I talk to, if you do that, you now have that mentor, I bet, is going to want to continue to help you because you've honored their time and you've honored their knowledge. And so I'm fortunate to have 4 key mentors in my life that I do this with. And I'm 41. I still prep hours for that meeting. And then I will follow up and say, I did this because you told me to do this. Terry's one of them. He's in his late 70s. And so I think that mentorship is one of the most important things to receive, and then also, to give. And I think my guidance, knowing the audience that you have and the type of leaders who are listening to this, is to find a mentor and to find someone that you can mentor. And emphasize the value of time in both of those relationships.
I love it. I ask all the guests on the podcast the same closing question, and that is, what's your favorite hotel?
Okay. So I have an epic love story with my wife, Tyler. The long story short is, when I was at the Air Force Academy, she was at CU Boulder. I snuck into a fraternity party she was in. I had the high and tight haircut in Boulder. I mean, looked like I didn't belong. Oh, to say the least. And I just got out of basic training, so I was like a caged animal. And I see this amazing, beautiful blonde across the hall, and I gave her the most cheesy line ever, like, "You're the most beautiful girl I've ever seen. Will you dance with me?" And we dated all through college. And then I was a total knucklehead when I got stationed in LA, and we broke up. That's the short story. There's a lot more to that, but we broke up, and we do not see each other for 4 years. I go back for a Air Force football game, and I asked her to coffee. And my whole goal was just to apologize for what a knucklehead I was. And I don't have a very vivid memory, but I remember every detail about this. When I'm sitting in the coffee shop, I'm a little nervous. I got my whole speech, prepared that I'm going to tell her. And I remember there was a glass in front of me that ice. I could hear the ice. I can see the setting now. She walked by, and then she walked, into this coffee shop, and there was a certain song playing. Remember that there's a certain song playing, and I start into my spiel, my apology. And again, we have a 30-minute hard stop. I'm not expecting her to really, receive it that well. Well, by complete grace, this 30-minute conversation turns into 5 hours. And it was one of the most beautiful, conversations we've ever had, and found out just a lot of things that had changed in my life and that had changed in her life. So we, a few months later, I'm going to propose to her. Okay. So she says, okay, I'm going to give this knucklehead another chance. And so I call the Montage in Laguna Beach. Okay. And I say, hey, I'm going to propose to my wife. And there was just a certain song that I'd love for your piano player to play, because it was going on in the background. I had to explain it all. And it was just, it's a country music song, not something that is normally played in the, hotel lobby of the Montage in Laguna Beach. But I've heard you talk about this, and this is what makes hospitality and hotels so amazing. The entire staff was excited about it, in on it, just it felt like a little stage was happening in play, because like we had organized it where everyone knew what was going on. And so we're in the hotel lobby, and the piano player starts to play, and it's this very, again, country music, Texas country music song that's playing. And I start singing that song, and I propose to Tyler, and the entire staff comes out and celebrates. So this is the power of moments, and the power of hospitality, and the power of brand. I don't care what the price is. Like on Tyler and I's anniversary, we're going to the Montage. Like we're in. Like we are all in on that brand, on that hotel, because they went out of their way to create that moment for us. And so, yes, my favorite hotel, the Montage in Laguna Beach.
That's an amazing story. I got to get this to Alan Firstman, who's the CEO or chairman of Montage.
Oh, please
that
do.
That is amazing. Trevor, it was awesome to have you on the podcast. Appreciate you. It's a great combo.
Thanks, Jake. Appreciate it.
Hey, everyone. It's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter @JWurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.